All right. Hey, thank you all for joining us today for our webinar. Cecil is here, how we can help. Before we begin, though, we are in what's called presentation mode. So you can hear us, but we can't hear you. If you have a question, please click the question icon on your screen, and I'll answer those, as we for the call and maybe after as well. You'll also receive an email with the slides from the webinar along with a link to recording on our YouTube channel. My name is Jason. I've been working with credit unions for 12 years on the customer service and sales side. We also have Steve Huntington joining us today. All right, let's talk about CECL. So what was wrong with the incurred loss model? Well, one of the comments we hear on our demos is what's wrong with the current incurred loss model? Why the change? This really goes back to the last crisis, and in FASB's opinion, they felt the incurred loss model did a disservice to the financial institutions by allowing them to not acknowledge losses until they were probable. The approach used to recognize impairment losses on financial asset had really long been identified as a major weakness, resulting in delayed recognition of those losses. So, at that point, FASB had a couple of options, right? Fix the methodology or do nothing. So if you don't do anything and the problem occurs again, well, then you expose yourself to people saying, well, why didn't you do anything to fix that? So clearly, FASB decided that they were going to fix it, and well, CECL is that fix. So fortunately for us, it just means learning a new way to calculate your reserve. But at the end of the day, we're just calculating a reserve, right? We like to say, hey, we're playing the same game just with a new set of rules. So we're just going to be focused on reserve. We're going to be, going about it in a slightly different manner. So let's talk about some of those changes. And I think you'll see here that there are a number of areas where CECL and the CECLSolver can feel very similar to things we've done in the past with the incurred loss methodology. And one of the reasons we like the WARM methodology is its similarities to the incurred loss model. First, CECL will be different in that we were looking at losses over a longer life of the loan approach instead of looking at losses over an annual or a couple year look back that most institutions do now with their ALLL. So now you'll make allowances for losses over the life of the loan pool. As far as some of the similarities, we're still going to go into pool assets, make Q factor adjustments and assumptions to justify those Q factors. So we're going to build on some of the similarities, but make a few slight changes along the way. So some of the myths here. So first, there is no one mandatory method for calculating your reserve under CECL. The NCUA has mentioned several different methodologies like the WARM method, but the choice is completely up to you. You choose your path, and you will have to defend this to your examiner and absolutely understand where your final reserve number is coming from and document that appropriately, right? And that's really going to be the case for any tool that you choose. The NCUA has also stated that your chosen reserve methodology, match the complexity of your portfolio. So really, for most traditional credit unions under a few billion asset size, a call report driven analysis using the WARM methodology is perfectly acceptable, right? You do not need to engage in highly complex modeling or loan level analysis. So when it comes to implementing CECL, there are some practical considerations. First is how much data have you collected? Do you have detailed loan level data going back at least 5 years? To do a more complex loan level analysis, you'll really need to have all of that and reconcile all that data before you even start your first reserve calculation. And that process can take a very long time. But for other WARM options, what is the cost? Is it Excel based? How much work do you think you'll have to put in to managing it all yourself? So also think about data from outside your credit union, right? What had the loss trends been in your state? How about how do your losses compare? Having good internal data is obviously important, but having comparable peer data will be very helpful, especially in areas where you have little to no losses. So in that instance, peer data can help establish reasonable and supportable CECL reserves and further support your reserve figure. But in the end, we feel that CECLSolver hits that perfect balance of simplicity and automation while still giving you the ability to add complexity where needed. And that brings us to why we introduced our CECLSolver, right? In the very beginning, we saw the original guidance for CECL, that guidance was far more complex far more complex, massive institutions. And we knew that really wouldn't work for the majority of credit unions out there. So we wanted to create a tool that was easy to use, collect the data for you, and honestly create a CECL tool that was just easy to understand, right, and follow at the end of the day. But we really also wanted to create a CECL solution that was quick to implement as well, right, and easy to maintain from month to month, quarter to quarter. And we feel we have done exactly this with the CECLSolver tool for credit unions. So let me turn it over to Steve for a brief demo here on the tool.
Yes, thank you, Jason. Good morning, everybody. Give me just a minute to get my screen shared. So bear with me. And as I go ahead and share my screen, just to remind everybody, we're going to do a live demo and walkthrough of a tool right now, but we've also added a bunch of slides to the presentation deck that sort of walk through it as well. So if you want to, we'll send everyone a copy of the presentation after the call today, and you'll have it in your PDF as well as in the recording. Here, let's see. Go. Let me know as soon as that pops up, Jason.
I can see it.
All right, excellent. So this is a live version of the tool as it stands today. Well, I'll make a note of some of the recent enhancements that we've done to the tool for anyone on the call who has seen it before, and we'll also talk about some of the things we're going to be working on to continue enhancing it as we go through this year. And as you'll notice, the CECLSolver tool is a bit of a living, breathing animal. As we've certainly had lots of changes to the expectations for CECL since the standard first came out years ago. At this point, the timeline has changed multiple times. As we've gone a lot of back and forth with auditors and with the various regulatory bodies and the NCUA and discussed with their accountants, we've worked on and fine-tuned different parts of the tool as we've gone along, and that process will certainly continue as we get into this year, as our regulators start understanding what looking at ACL calculations in a real world environment, right? For thousands of credit unions, they're certainly gonna improve their understanding of CECL, and also kind of get much more specific on the expectations they're going to have as we get a lot of exams done this year. But as you see in front of you, this is a summary page from the tool. One of the things to note on our CECLSolver tool, this entire tool lives in the cloud. And what that means is the second you first log in, all of your historical data from the call reports is all preloaded into the system, as well as your peers as well. And we'll show you what that looks like in just a second. Excuse me. But as you change any updates, any assumptions, any inputs into the tool, the entire tool recalculates pretty much instantaneously on the fly. So when you change a look back period, when you change your balances, when you change an assumption about Q factors, you can see in real time exactly what that the impact of that change is going to have, not only on the reserve for that segment, but on the entire reserve for the whole portfolio. So we designed it that way because it makes the process of fine-tuning your reserve calculations a heck of a lot easier and more efficient on an ongoing basis. You don't have to plug in hundreds of assumptions and then run the report, wait for the entire thing, print it out, and then look at it, and then try to compare it to something you did a week earlier or a quarter earlier to try to reverse engineer what caused the big or small changes that you saw in your outputs. You'll see it kind of happening in real time, and I think that makes the whole process a little bit more efficient. But as Jason mentioned, we are utilizing a lot of a WARM-based method, WARM standing for weighted average remaining maturity. It's certainly one of the more straightforward approaches to CECL that's been vetted and approved for the vast majority of credit unions out there, not only by FASB, but also by the NCUA as well. And the first step in utilizing the WARM method, or honestly, for any methodology for calculating your ACL under CECL, the first step is really going to be getting a handle on what the average remaining lives of a loan you currently have on the books is, right? Since CECL, in a nutshell, is all about estimating losses, not over any individual period, but estimating losses over the remaining lives of the assets. We have to get a feel for what the remaining lives are. That's the one piece of the puzzle here, that first step that we need a little bit of your help on the front end, because calculating average remaining lives of our loan buckets is not something that we can get directly from the Form 5300s, right? It doesn't ask you to do those calculations on the call reports. And so we work with you to do those warm calculations. You have a lot of options when it comes to calculating your warms. If it's something that you can get currently from your ALM provider or your core, where you can request a report that does warm calculations for you, by bucket, by call report bucket, or by whatever pools you want to be using for CECL, then that's great. We have not seen a lot of help from a lot of the ALM and core providers to give us the warms that we really need. And so most of our users, we have a few hundred credit unions actually who are using our tool at this point, which is great. So we have a nice, good sized user base in the industry. But a lot of them are doing the calculations for warms themselves. And you can do that with or without our guidance or our help. So as rest assured, as much or as little assistance as you need in calculating those warms as a very important piece and the first step in doing your ACL calculations, we can help with. First step that we provide is an Excel-based tool that shows you exactly what information you need from your loan level data in order to calculate the warms. And you can either utilize that Excel file, it's yours to use, with or without our assistance, all the way up to if you call us and say, hey, listen, we just don't have the time or the resources to do these warm calculations on a quarterly basis and continually update it. Is there any way we can send you guys the loan level data and you can just handle it for us? And yes, we can certainly do that as well. So when after today's call, if you want a one-on-one demo of the tool with your data, give us a buzz, and we can talk all about your options for warm and that loan level data. But I'll go ahead and click on the warm estimator tool for just a second so you can get a feel for what that looks like briefly. That's an Excel file here that downloads right in the browser, and I'm sure it's going to pop up on some weird screen here. All right, hold on a second. Here we go. So this is the warm estimator tool. We have a summary page which kind of presents some different methodologies for calculating the warm and gives you some options. We also have the NCUA's data that they more recently released that give us some great industry guidance directly from our regulators about prepayment rate assumptions and default kind of industry warm values that you could certainly use to begin with before you've had the time to look at your own data. And then it goes through each segment of the portfolio and gives you a couple different methodology options with prepayments built in and amortization assumptions and choices for calculating the warms. So I don't want to dig too deep into that on today's call, but we certainly can help you with the warm as much or as little as you all need. And we're happy to do that on a call. So once we plug, let's assume that we've done our warm calculations and we plug them into the tool here. Why don't we go ahead and use the new vehicle loans as our guinea pig for today? Let's say that we calculated our warm was 3.25 years for our new vehicle loans. As soon as we type it into the tool here, it takes a couple seconds, and everything just recalculated on the fly across the board as it pertains to CECL for new vehicle loans. And what I mean by all that is, if we know the average remaining life of our new vehicle loans is 3.25 years, we know what CECL is really requiring of us is that we project 3.25 years worth of forward-looking losses on that segment right now, right? Losses over the remaining lives of the assets is what CECL demands. So in order to do that, this is a summary of how that's done. Obviously, that's a pretty high-level value, and there's a lot of details that go into it. But luckily, because of the way we've designed the tool, all the supporting details that go into this historical lifetime loss rate are right here in the historical tab. So, the first step in estimating 3.25 years worth of losses is to look at and see, well, what kind of losses did we have over a historical 3.25 year period, right? And so that's what we're going to find here in the historical tab. Here's where all the math happens on the historical data. You'll notice here, when I pull this up, it's already pre-populated with all of your balances by call report segment going back in time further than we need to, well over a decade for CECL purposes. Now, this is where things got a little bit hairy last year when the NCUA decided that it was time for them to completely redesign all the asset quality related line items on the call reports. And so we got all this new segmentation here that we've always had balance data for things like construction development loans, multifamily loans, at least since 2017, some of the owner occupied and the other commercial loans. But what we didn't have was discrete charge off and recovery data trends, which is what you need from a CECL standpoint, from an asset quality standpoint. But now we have that. So we have all these legacy, these old segments that we used to have only 8 or 9 of. And now we have much more rich segmentation that's available to us starting at March 31st of last year with the updates to the call report. So that's all been integrated here. And what you can see is we've highlighted the look back periods for each segment. And you'll notice that by default, we match or we mirror the look back period to the WARM, meaning if we're trying to estimate losses over the lifetime of an asset and over the remaining life of an asset, and let's say that remaining life is 3.25 years, like for the new vehicle loans in this sample, it makes sense intuitively to us that, well, we're going to look back at an actual 3.25 year period in the past. So we're going to have that look back period that matches the remaining life of the loan. It makes the math simpler and everything else. There are ways we can modify this in the tool going forward, and we can walk through that at another point. But you see, we've highlighted a 3.25 year historical period, and we're going to analyze your historical performance. How did your balances change over that 3.25 year period? How many charge-offs have you had? What direction are those charge-offs headed in? We look at recovery. So all that data is right here, where we can see charge-off, gross recovery data, net charge-off data, and net charge-off ratio data. So we kind of work our way down and we see what these loss rates were by period going back 3.25 years for the new vehicle loans. And then we do an aggregate calculation. So we come up with a lifetime loss rate of, let's say, 25 basis points in this case. You'll notice all these lifetime loss rates here that are calculated are modifiable or overridable. If you had a specific situation in the past where, let's say, you had a charge off or a recovery that was, well out of the norm for your typical trends, and that's something you can manage in the Q factor section, or it's something you can actually just go back and manage right in the historical data section. If it was an erroneous filing, but you haven't gone back and refiled that call report and gone through that process, this is where you can clean up some of that as well. But that's the first piece of the puzzle for CECL, really, is before thinking about the future, we just look at the past and look at what the past would suggest our loss rates have been. And the second piece of the puzzle, the second half of CECL really, is all the fudge factors, right? All those qualitative factor adjustments that are going to take our historical experience and turn it into what we expect moving forward. This is where peer data can be critically helpful. I'm sure probably many of you on the call today have certain segments of your portfolio where you just haven't really had much, if any, loss experience over a significant period of time. And we certainly know that that's not going to mean that we're allowed to just have a reserve of 0 for a whole segment of our portfolio just because we haven't had any losses in a while. We're going to have to find a way to create and justify some sort of CECL reserve, even if our historical loss experience wouldn't, in and of itself, wouldn't suggest it's necessary. That is where we can use peer data, because not only have we assimilated every call report that you have ever filed into the tool when you first log in, we've done the same thing with every other credit union in the country. So we can say, hey, even though we've had no losses on our 1 to 4 family mortgages over the last 6 years, we can look outside of our 4 walls at the environment around us and say, hey, we're going to analyze all the mortgage loans in our entire state amongst similar sized credit unions and see what kind of losses are in the environment around us that our peers have been experiencing, even if we haven't experienced them. And that gives us a great justification or sort of a narrative as to for your qualitative factors and adjusting your historical loss rate up to some expectation of loss going forward. So when I click on the Q factors tab, this is where kind of your home base for all those qualitative factor adjustments. We see here we have your historical loss rate. I believe, remember, for the new vehicle loans, it was 25 basis points. For the mortgage loans for this credit union, it was just 12 basis points. But here is where we start modifying your historical experience for how you think it might be better or worse in the future. You'll notice, you'll probably recognize a lot of these sort of predefined qualitative factor adjustments. These are coming directly from the existing interagency guidance that we've had for a couple decades now for loan loss reserve accounting. You certainly don't need to make adjustments for every one of these potential Q factors. These are just suggested things you at least need to consider from a Q factor standpoint. You know, changes in lending policies and procedures, portfolio mix, management and staff, problem loan trends, etc. You can remove any of these Q factor adjustments that you think just aren't applicable to your institution at all. Let's say problem loan trends. If you just want to get rid of it, get rid of it. If you want to rename it, you can rename it. If you want to add any custom Q factor adjustments you want right here, let's say you had a situation where you had one individual relationship that, you know, has been a problem for a long time, and you've been working with that customer and you finally decided you needed to cut bait, you know, more recently, and there's a large recent charge off there. It's having a huge impact on your historical experience, and you want to kind of back some of that out for your future expectations. You can make a custom qualitative factor adjustment and then explain what you're doing and where you're doing it in the portfolio. As you make adjustments to your Q factors, the reserve, the CECL estimate recalculates on the fly. So for example, for mortgage loans, we see here, we have a nice little summary chart that shows kind of all the most important long-term trends for CECL. And that is, you know, your institution's long-term trend in losses, that's the blue line, your peer group's long-term trend in losses, that's the green line. The shaded gray area is the look back period that we're using. And the orange line is the total CECL estimate based upon all the inputs that we have. So if I change a Q factor adjustment, let's say I add a 25 basis point adjustment based upon portfolio mix. As soon as I do that, you watch this chart. It just updated. The CECL reserve line went up 25 basis points. As you add Q factors, the net adjustment, the sum of all those Q factor adjustments recalculates on the fly. And this is where you can make notes as you're going through this process on your reasoning or explanation for why you're making these adjustments throughout the portfolio. This is just a great administrative tool, not only, you know, externally, because it provides that audit trail when you're being examined, when you're going through an auditing process for explaining exactly where, when, and why, right? You made adjustments from a reserve standpoint. It also helps internally when you come back to this next month, next quarter, to update it and recalculate your required reserve. This is where you make notes of what your thought process was last quarter when you made adjustments, so that you can remember it and decide if they're still appropriate assumptions or if they need to be modified. When you make these notes, they get attached to the segment throughout this analysis. Whenever you save a scenario, whenever you export it, all the notes get exported and attached to each segment, so it keeps it all straight. As you click through the portfolio, you'll see the summary tab, the summary charts update sort of on the fly. So you can click through here and you can see what those long-term trends are in losses, not only for your credit union, but also for your peers. And also we have a good number of economic trends down here that you can overlay kind of over top of your loss experience or your peers. So you can look for any trends there that you might want to take into account in your Q factor adjustments. Once you're finished with the Q factor tab and you have your net Q factor adjustment that you're satisfied with, it's already translated right over here onto the summary tab. As you are making those changes in the Q factors, everything is linked and synced. So it's recalculating the total reserve on the fly as you make any of those adjustments. One of those important Q factors, as I mentioned before, is that peer data. So when we're doing the peer data, what we're really doing is this entire historical analysis that we're doing on your credit union, looking at charge-offs, recoveries, balance trends over the long term by segment. We're actually also doing that for every single other credit union in your peer group simultaneously in the background. So literally just crunching millions and millions of numbers in order to come up with this. This is sort of peer group average loss trends by segment using the same segmentation, apples to apples, that we're using for you. And then we overlay your look back period. So we can, in effect, calculate a comparable apples to apples lifetime loss rate for each segment that pertains to your peer group as opposed to for your historical experience. This really helps where, again, if you've got 7 years worth of zero losses, you can look and say, well, looks like my peer group got on average 16 basis points of losses compared to my 0. I'm certainly going to take that into account as an environmental factor. Once we have all those Q factor adjustments done, we've in effect calculated our expected future loss rate. It's just our historical experience plus or minus the sum total of all the adjustments to it is equal to what we expect moving forward. Once we have an expected loss rate, then we have to apply that to the appropriate current balance. So by default, these balances are going to pre-populate when you log in as your most recent call report values. That's the most recent data that we have access to publicly. But you'll notice they're all certainly overridable. So if you want to come in here and you want this to be as of, January 26th, you can override these 12/31 values with your January balances, and you can have the reserve calculation be as of any date you want. It doesn't have to just be as of a quarter end. Once we plug those in, we can also make adjustments to our current balances if there are loan balances that you want to exclude from the CECL analysis. And that would be if you had any, CECL or PPP loans still, or CECL, COVID, sorry, or PPP loans still on the books that are, government guaranteed. If you had a large portfolio of SBA program loans that had a decent government guarantee, any balances that are either outside the scope of CECL or guaranteed to an extent that you don't want to assume a future loss on that balance, you can exclude those balances here so that they're not inappropriately calculating a reserve on them. That would also, by the way, apply to fully share secured loans, right? If you've got $1 million worth of fully share secured loans in the all other unsecured bucket right here, you'd want to come in and back that 1 million out of your call report balance so that you're not calculating a reserve on a loan that you can't have any losses on. Once we've done that, the last kind of piece of the puzzle is to deal with any individually assessed loans, any loans that you feel you need to split off from the herd, cull from the herd, so to speak, and manage on a one-off basis. Now, this is not necessarily going to be the same list you would have had in the past for any loan that was impaired by the old impairment standard. The old threshold for impairment ceases to exist under CECL, right? Just like TDRs are now going the way of the dodo and are not going to be on the call reports going forward at all either. The threshold by which we determine when we're going to take a loan, maybe that's, default is imminent and we have a good idea of what the loss might be, a relatively higher threshold most likely for when we need to do that. But without getting too detailed into that, we do have a part of a tool, a module here that you can plug in the loan level data or if you want to summarize it to the segment level, that's fine, of all your individually assessed loans and loss expectations there. Let us know where in the call report they're coming from so we can back them out properly. This is also that we don't double count expected losses, right? Let's say we have an expected loss on an individual mortgage loan that is in default or currently in foreclosure. If I plug that information there, go back to the summary, I'll see that the tool automatically has backed out that $350,000 loan from the pool in order to not double count the loss. And so what we end up with is a CECL reserve for the collective pool, and then down here, an additional small reserve for any individually assessed loans. That's kind of a step-by-step basis, how you run the tool and how it calculates the CECL reserve from top to bottom by segment. Then we layer in any reserve for held to maturity securities. We have a separate tool here, module here that where you can plug in if you have any there. Now, for a lot of credit unions, for most of you, this is going to be a negligible, if not just completely zero value, because it's only for the held to maturity securities and it's only for non-guaranteed ones, right? GSEs and government guaranteed held to maturity securities have no risk of credit loss. They may have a interest rate risk, but not real risk of credit loss. We'd all have bigger fish to fry if that were not the case. But really, this is just if you have a bunch of corporate debt on your books held to maturity, then you might need to look at this a little bit more carefully. And then finally, after we've done all that, we have to take a look at your unfunded commitments. So this is a piece of the puzzle that's relatively new under CECL. It's not something that was even on the call reports before. It will be starting on March 31st. There's going to be a new line item on your call report that asks you to calculate an allowance for off-balance sheet credit exposures. It will not be next to your loan loss reserve in as a contra asset account to the loan portfolio. It will be in the other liabilities section of your balance sheet where you manage this allowance for off balance sheet credit exposures. And pretty much what it means is, you know, we can pull out the unfunded commitments, we can extract them from your call reports and enter them here for you, which we do. Then we work with you to figure out which of those are unconditionally cancelable, meaning we don't have to deal with them from a CECL standpoint. Like credit card lines, unused credit card lines are always kind of a definition of unconditionally cancelable. Overdraft protection commitments, a lot of the time as well. And sometimes HELOCs, sometimes not. That's more of a gray area. And once we've netted out the cancelable ones, we have sort of a net unfunded commitment that we have to, you know, that is an amount that you're sort of, you know, you're on the hook for potentially lending and could potentially have losses were it to be funded. So then we need to jump through some mental hoops here, because in effect, what they're asking of us is that we project right now long-term potential future losses on loans that don't even really exist yet, right? So it's all a little bit hypothetical here, but we wanted to at least give you a methodology for going about that. So we help you, you know, we look at the estimated probability of funding. We talk about how long these commitments, you have these commitments legally for, whether they renew annually, which they do typically, which is our default setting. And then what kind of losses would you have or might you have in the future if they were to be funded? Luckily, we have some good default values there because we just did a big, long study of what kind of losses you have on the long term on your portfolio. So we get to the end, we get some sort of value here for off-balance sheet credit exposures for unfunded commitments, and then it plays into the summary tab right here. If you have more questions on that, we can do that on a one-off basis. I don't want to get too deep into the weeds on one particular topic like that for today. We just added a new function that we have here on the tool is an area where you can attach any internal files that you have that you want to keep with your reserve calculation, your reserve analysis. Meaning that if you've done a bunch of taking your loan level data, put it into Excel to calculate your WARMs for each of your scenarios, you know, and you want to attach that Excel file, or if you have a Word document where you've built a narrative around your explanation for certain Q factors, whatnot, any ancillary files that you want to attach to a scenario or just attach to the tool here that you can access easily and kept securely along with those scenarios, you can now do that here. So it's a nice little tool to drag and drop files, make notes on those files, and then keep them organized here with the tool. Administratively, as far as how to manage the tool, once you've built a scenario exactly the way you want it, you'll go ahead, save it as a new file, give it a name, give it a date. As soon as you do that, it's down here saved in your drop-down box. You can save as many scenarios as you want. There's no limitation, no additional fee or cost. This drop-down box will go down forever if you want it to. And you can also have as many users on the tool as you'd like. If you have 2 or 3 people you want to use the tool, it's all built into the pricing, so you don't have to, there's no seat licenses or anything to that extent. And you can come in here, you can access your old scenarios if you want to see, you know, look at last quarters and then just kind of update it and then resave it as a new one, or not resave it, but save it as a new one so that you don't have to recreate the wheel every quarter. You can certainly do that. And there's also a couple different ways you can export the data or export the tool. Once you're ready to share it externally, you know, with your board, you might just have a summary result you know, as a PDF. Or if you're in an audit and they want all the nitty-gritty details, you can export the entire tool, all the pages, with the charts, with the summaries, with the economic data, all of it, and you can export it as a PDF. or you can export it directly into Excel, which is nice. When you export it all into Excel, it retains all like the spacing, shading, and visual formatting, so that you could export the tool to Excel, make notes, add columns and rows where you feel like you need to, and then print it off from there to share it with internally or externally. Let's say, if I wanted summary and I wanted, peer data and some Q factor information, and I wanted that as a PDF. Just takes a few seconds and it generates an Adobe Acrobat file that's got all the relevant data that we just asked for. There's also a newer tool that we have in the auditing process. We found that a lot of times our users want more detail on all that historical loss data that goes into the calculation of the historical loss rate. Since this is a big piece of the puzzle, we present a lot of the annual data here, but this is not every piece of data that you need to calculate the value. There are quarterly data in here that's also used. So if you needed a data dump of all the historical data in order to, perform a double check from an auditing standpoint or anything else, we have a new Excel export where you can get that data that way as well. So hopefully that's helpful. As you go along using the tool, we have a bunch of resources to help. There is a visual user guide, which takes you step by step through using the tool, with a bunch of best practices and notes, things to think about as you're upgrading the tool, and kind of how to utilize it. So hopefully that's your first step. If you're confused about something in the tool, or if you get stuck somewhere, first thing to do is look at that user guide, because it'll probably help get you unstuck. A methodology guide and a white paper for some light reading. Draft of an implementation letter. This just helps you something for your files that you can use. We have the results of our SOC audit that we do on the tool, if you need that for your processes. And this is some more support. This is an Excel file for Q factors. It kind of helps you come up with a framework for deciding what level of Q factor adjustments you need, where you can kind of say, hey, moderately higher risk equals a 20 basis point adjustment, extremely higher risk is a 50 basis point adjustment, and you can tweak that, and it gives you provides a good framework for more detail on your Q factors. So you can look at that Excel file, and that's yours to keep. This is a summary of all the changes to the call reports last year, and this just helps show how we come about those historical lifetime loss rate calculations. So just another template that shows you how we do all of that math if you need it. And we're also going to be adding in here some a sample policy statement. We've been getting a lot of requests from users to help them start drafting their new reserve or ACL policies, right? And so we can provide that language and some templates there as well. There's also all these public resources from the various regulatory bodies and the NCUA that talked about the transition, that talk about the WARM methodology directly from FASB and everything else. So we hope that, as a whole, this tool provides you with the historical data, with the templates that you need in order to not only make the transition to CECL, do that one-time adjustment, which you're all probably thinking about right now, and then on an ongoing basis, just continue, calculating your reserve quarterly or however often you do it, and sending that through the provision, just like we always have with our ALLL. At this point, I'm going to stop sharing the screen and turn it back over to Jason. We'll touch on a couple slides real quick, and then if anyone has any questions, you can shoot us a note, a comment right in the chat box, or we'll leave a couple minutes for that. So Jason, why don't you go ahead and, all right, so we're back on the PowerPoint presentation here. This looks just like the tool that I was just showing online, but we just wanted to have you guys have some pages you could print out for reference. This is the summary page here. These are just things to remind you as to how to manage and how to use the tool. Next slide. The Q factor detail. Next slide. This is that interagency guidance that we've had for a long time now, which suggests different potential Q factor adjustments that you should consider. And we're still going off of that, just like you guys probably currently are. That's the individually assessed loans template. This is a new file upload feature that you can make yourself avail yourself of. Some more information about peer data. By default, we use your NCUA peer group. The NCUA is pretty simple. They've got 6 peer groups, right, by asset size, and you're in peer group 1 through 6. And we've kind of refined that to allow you to be choose your level of geographic specificity. If you want to just look at, let's say you're in peer group 5, you're 100 to 500 million in assets, you only want to look at California credit unions that are, in peer group 5, or you just want to look at Southern United States credit unions. You can tweak that geography of the peer group and then zoom in on your more local area if you'd like to. And this is just part of a tool, kind of outside of a CECL tool, but something that we're offering for free for all of our users. The ability to just get financial statements on any credit union in the country. So it's just kind of a financial summary at this point, which shows some performance metrics and balance sheet and equity and everything else for your credit union, or you can search for any other credit union you'd like and see their historical financials here. On the next slide, this is also a great tool for just sort of getting a feel for what the credit unions around you look like. You can sort by any geography, and you can just get kind of a snapshot of what your peers look like, and you can sort by things like, who's heavy in commercial loans, who has more or less fee income as a percentage of their, their balance sheet. This is also where you can tell who's in your peer group. If you want to see who the other 100 to 500 million dollar credit unions are in California for your NCUA peer group 5, you can go here and you can just sort by asset size, and you can see exactly who those peers are that make up your peer group. So hopefully that's additional value as well. We're going to fly through this really quickly, but something we've been, the warm estimator tool that I showed you guys, that Excel file, it's had a couple iterations because we've learned more about from the auditing process and from the NCUA as well as to what they're going to expect and what they're going to allow on warm, on calculating remaining maturities. It's such a critical assumption in CECL, whether you're using the warm method or any method, it's a critical assumption. So we provide some good guidance there. This is a snapshot of that of the warm estimator tool that I already showed you. The Excel file. This is that summary page where you can see, what a raw kind of warm calculation is, how much it drops when you adjust it, but when you put in a prepayment assumption, how much more that warm drops even lower once you take into account amortization. So you do have some options, and then what the NCUA default warm values that are peer-based are. So lots of data there. That's the same thing there. And before the NCUA came out with all this very helpful prepayment speed and warm guidance, we were all kind of left to the wolves to figure out what's an appropriate assumption to start with. And so we had done a lot of research before this came out. I believe this was October when the NCUA came out with this. So if you go to the next couple slides, Jason, before that came out, we were using the FHFA. They have a quarterly prepayment monitoring report, which gives us some good idea of long-term prepayment trends for mortgage-related loans. And then we used some other resources for non-mortgage related loans. So a wealth of information there to help you defend your assumptions on things like prepayments and warrants. You can keep going. And yeah, and this is what we mentioned earlier or alluded to. If you don't have the time or energy or resources to do those warm calculations, and you're not getting any assistance from your ALM or core, and you'd like us to just kind of handle that for you, we would ask you for certain loan data information from your loan tape, and you could upload it. You'd be uploading it to us in a secure site, and then we would analyze that. We would organize it by the call reports, and then show you how that give you those warm calculations and allow you to change assumptions in that data. Jason, I'll let you go ahead and take it from here.
Yeah. All right. Let's see here. Yeah, just give us a holler. We've already collected all your call data, so we can get a good idea of what your reserve looks like now under CECL. I did have one question come in, Steve. Upon implementation of CECL, if you happen to be under reserved, are you required to take the entire provision expense all at once?
If you are under reserve, so this is it's a great question, and the rules for it, or what they built around this, has changed a little bit over the last couple years, or a year and a half at least. And that's, if you look in the CECL resources, the public CECL resources, there is that very long, very dry document, which is called the NCUA transition rules document. And I'll give you the summary of that, because that's a long document to read. And what it says is, if you are under reserved, if you need to make a big one-time day one adjustment, you still make that adjustment on day one. When they say that, well, you can phase in your shortfall over a period of 3 years, or not even you can, you have to. They're just going to automatically do this, but it's only for calculating your net worth ratio. It's only for purposes of calculating the net worth ratio for capital standpoint. You still have to make that adjustment on day one on the balance sheet, and it's a direct balance sheet adjustment. It is the day one adjustment. So when you say, hey, on January 1st, my reserve using the old methodology, the ALLL, was $2 million. My reserve, I just calculated my reserve under CECL, my ACL, and it's $2.5 million. So I have a $500,000 shortfall on day one. I'm going to make it's not going to go through the income statement. There is going to be an adjustment that comes directly out of my retained earnings or undivided profits and directly into the reserve on the balance sheet. So it's just a balance sheet transfer on day one way or the other. If you're over reserved and you have excess, which there are people, many credit unions and banks that will and will be able to defend that excess, then you will have a one-time direct deposit into your undivided into your retained earnings from the reserve. That's going to be less common, obviously, for obvious reasons, but it will happen. So that happens on day one. However, for calculate, if that will drop, if you have a big shortfall, it's going to drop your capital ratios, right? So when you calculate your capital ratios over the next 12 quarters, it's going to phase in. So only 1/12 of that shortfall will be phased in the first quarter, and then 2/12 in the second quarter, all the way till 12/12 of it are phased in 3 years from now. But it's only for calculating that net worth ratio. So if it puts you capital lower than you need to be, you're going to get credit for, they're going to phase that in. But from an income statement standpoint and everything else, everything still happens on day one. But it's a good question. Hopefully that helps.
Yeah, it would be more beneficial to the entirety of it, or two, right? I mean, you wouldn't want to do just some of your shortfall and then later do the rest.
And then you don't have any choices. That used to be, it said you could opt into a transition where if you wanted to have to have it phase in for risk-based, or sorry, for net worth capital ratio calculations, if you wanted to phase in over 12 quarters, you can if you have a shortfall. The NCUA just said, you know what, that's forget the election thing. We're just going to do the calculation that way for everybody. So everybody that has a shortfall will automatically be phased in for a net worth calculation. At least that's what they said last year. We're going to see a lot. We're going to find out a lot more about how that happens in the real world over the next couple months here.
Yeah, definitely. All right. Hey, thank you all for joining us again. Give us a quick shout. I'd be more than happy to set up a demo with using your data so we can see exactly what's going on in your credit union. Also, check out our CECL Coffee Talk webinars. They're fantastic. More of an open forum setting where we kind of pick your brains, bring on all of our current users, show them what new topics are out there, what have we heard as new guidance, new updates, and just what is going on. So
yeah, we're going to be talking a lot about all this, what's on everyone's mind right now, right? How do we do that initial calculation? What happens? How do we manage the day one? If we're doing that day one, in March at some point, we're going to retroactively do it as of January 1st, even though we might be calculating it in March or April. We're going to talk about all that stuff in detail, and it's a very open forum. You can ask any questions you want. We spent a lot of our time just asking questions as they come in. We've got it's been a very popular format for us. I think we've got about 200 credit unions join us every single month on our coffee talk, and tomorrow is going to be no different. I think we have well over, I think if we add up, we have 2 different coffee talks we're doing tomorrow, and I believe we have a total of about 400 or so institutions that are going to be joining us. So it's going to be very popular. I wouldn't say it's going to be a good time, but as good of a time as you can have with CECL, right?
Hey, thank you all, everyone. Thank you again for joining us today, and I look forward to speaking with you soon. Take care.
Thanks, everybody.